Hello and welcome to Spy Money. Today we're going to talk about how to buy options, puts and calls. We're going to do both of them on here, and we're going to use Spy. A lot of people trade Spy. I trade Spy quite a bit. I like it. It's an easy one. It is the ETF of S&P 500, which is SPX, and SPX. The future of that is backslash ES. So we'll use this one here, and we know that it's been going down, and I had puts in it. I bought them right on through here, and I sold them off right here because I thought it was just going to dump and then go up. I wish I'd have held them because I'd be down here now, and I don't know where it's going to open tomorrow morning, but it's probably going to be in this range. Hopefully it's going to rally tomorrow, but we don't know yet. So what you do is you pull up, you put your ticker in. This is Thinkorswim platform, TOS they call it, and it's with TD Ameritrade. That's what I trade everything on. And if you go to your trade and make sure you go to all products, and let's go, like here's your March the 2nd of 2020, and then you got 8 days till it expires, and this is a weekly. Now a lot of people, like you can do one more day where this one expires tomorrow. You can do the weeklies or you can do the monthlies. A lot of the institutional trading will use the monthlies because it's easier for them to know, when they're going to get out. It's always 30 days away when they do it. So I trade them all, and you can see this one right here. I've got a position in March 23rd, 29 days left, and that's what I traded. Of course, I did buy it last. I think it was last Wednesday, so that would have been around 30 days or so. I always try to buy 30 days or more. It's safer. If you're going to buy them and you're new to option trading, you probably ought to go 45 days or more. And that'll give you a little bit of time in case you're a little bit wrong on it. SPY will typically, if it drops, it will usually recover within 6 days. So if it goes to 300 today and then tomorrow it goes to 301 or whichever, that's 1 day. But if it keeps on dropping before it comes back to your original point, so let's say it this way: if it was 330 and it dropped down to 300, was probably going to get back to 330 within 6 days, statistically. That's not a guarantee, but based on historic data, that's about right. So if it does go down, if you've got time, then you can wait that out. So if you're looking at 6 days, let's call it 10 days. Well, if you had a 30-day option, that's going to put you closer to 20 days. At 21 days, your theta starts eating your premiums up. So you always want to sell before 21 days is up. So whoever has these options right here, they're getting eaten alive. This one right here, they've just lost all their money if they had calls. It's gone. They will not ever recover out of that. But if you had something like down here where you had 40, 54, 82, even my 29 days left, I'm going to recover because I've still got another 8 days before theta starts eating my option. So you always want to have time on your side. That's the main thing with the option. So let's try like the 54-day one. That one's April 17th, 2020, 54 days. And it's your monthly. It's what this is. There's a quarterly, there's a weekly, and here's the monthly. If there's nothing, there's a monthly. So you're going to have two different sides on this. And we're going to scroll down. And we're going to have calls right here. And then we have puts over here. Now the purple is called out or in the money. So right now these are inside of the price. So this is 329 and you got 320. I'm sorry. Yeah, 329 would be here, but anything up through here would be in the money. And then when you come down here, it's going to be out of the money. So these calls are actually lower than this price. And with them being lower, then the calls are actually inside, actually below what the price actually is. So you're in the money. This one would be out of the money. So if we're at 329 now, we're not at 335, so 335 would be out of the money because you're actually going to that point. And then over on this side, you have puts. Now, these are out of the money, and because it's not this low yet, but it is this high. So these are in the money. How I buy mine is I always buy out of the money. I never buy in the money. I buy out of the money. Now, if you buy out or in the money up here, then you won't make as much money on the premium as it goes up. But if it starts going down on you, you won't lose as much as if you were down here. So when you're out of the money, if it starts going the wrong way, you're going to lose more than if you were up here. I always buy down here because you can actually make more money. And if I'm doing my job right, I should have the charting done on the SPY to where I know that I'm going the right direction. That's not to say bad news will come out and destroy it like it did last week, but typically you're going to be going the right direction. So when you come down here, there's a lot of numbers to look at. You already understand in the money and out of the money. And you have an implied volatility, you have a theta, a delta, open interest. These are the three, or I guess four that I look at. Open interest is the number of contracts that's actually open. If this is less than 100, you shouldn't trade it. Like probably none in SPY. There's some. There's hardly any contracts available right there. So those are the ones you probably would not want to buy. You would want to buy something that's got higher volume or a higher amount. And then you have a delta. A good way to buy calls and puts is if you buy a 30 delta or better. 30 is kind of the rule of thumb that everybody tries to buy. And if you look, there's 31,522 open interest there. So there's a lot of contracts right there. And if you come over here to the volume, you can see the volume is a lot higher than where it is elsewhere. There's one a little bit higher there and one there. But for the most part, 30 delta is your kind of sweet spot on a call. Now, if you don't have a 30, then go to the next one up. If you go over 35, you're going to start paying a lot more. I sometimes will buy down in here. So if I'm going way out and I think that according to the chart, it's going to keep on going, and let's say it's going to go, you think it's going to go 10 points. Well, if you're at 329, then you're going to be at 339. So this would be 10 points, and that puts you at 32 delta. So that would be a good starting place for you to go. That one's 408. Not on SPY, but on some of the other stocks that I've traded, sometimes it'll be like 408, and then like this one's got about 41 cents difference there, and then this one's got 49 cents. So I would rather buy something that's got a bigger spread, because if it moves up, I'm gonna make more percentage. In some of the stocks that you get into, it'll be like you'll come down and it'll say 274 and there'll be $1.50. Well, then there's a big jump there. I will choose the $1.50, and the reason I do is because if it moves $1, I'm gonna make a huge percentage. So that's what I look for. But that's only if you go long term out. If you're going to scalp and you're going to do a same week expiration and you're just going to buy it for like a daily, you want at the money, and that's what this first line is. So you got in the money, the first one is at the money, and then this one is out of the money. So when you're hearing people talking, you got ITM in the money, ATM is at the money, and OTM is out of the money. So that's how I try to choose the stocks that I'm buying, or the options. And this is the calls. And if you come over here, the theta. The theta is what actually eats your premium. And as you can tell, this one is going to cost you more money per day than what these are. Because this, even though it's a 10, it's a negative 10. So that's an actual lower number than what this is. And if you come down here, you can see that these are zeros, and they're going to eat more premium than what these are. So the higher the number, the worse it is on your premium. Now, if you come back over here, you'll have puts. These are out of the money, at the money, and in the money. So it's just the opposite. So I always buy in the black. If you buy in the black, then that's where I buy. You don't have to, but that's where I buy. And then you do the same thing here. You come down, you look for the delta. Right there is the 30 delta. So at 30 delta, you can see the majority of the people are buying there. And as far as your volume is good too. And so as long as you're buying in that range, and if you just want to pick a 30 and that's all, then you can't go wrong by doing that as long as you're going the right direction. So puts is going to be going down. You think the stock's going to keep on dropping, and then the calls are when you think the stock is going to go up, or the ETF. So that's how I buy them. When you do buy them, all you do is click on here, and you want to pay the middle price. So this is $3.95 and $3.91. So the whole idea is to try to get it for $3.93. Now you can buy a market order, and a market order, the market maker will actually just throw it in. You won't pay any more than this right here. But if it's moving really quick and you try to do a limit, sometimes you can't get it, and you'll end up paying a lot more money. So if the stock's really moving, then I will sometimes just go ahead and hit a market order. That way I can just get in, because I know it's going to go the direction that I'm wanting. So that's up to you as far as which way you buy. If it's say it's you're buying puts and the stock, let me go back to it. Let's say you know it's going down, but this is coming up. Well, what you can do is, if you're buying on the way up, buying a put, you're going to get a cheaper price than if you start buying down here. So right here it might be $4. Right there it's going to be $4.50. So if you buy in the opposite direction that you're trying, like a put, if you're buying on the way up, the premium is going to drop. But as soon as it starts pulling over right here, the premium just starts going way up. So a lot of times you're better off to try to buy, if you know that it's coming down and all your charting's right, you want to try to buy as it's coming up a little bit. And that way when it starts coming down, you're going to make a whole lot more money. Now, when it comes down and it starts coming back up, you're going to lose right there. Even though this is lower than up here, but you'd make a lot more money here than you would there. Now, once this comes up and starts consolidating like it does, it comes to here. Now this point is the same point as there. You would make more money right here than you would right here because of all this consolidation. So you got to take that in consideration about when you're buying your calls and puts and stuff like that as far as the direction. You're better off to buy in the opposite direction, even though you might at first be in the hole a little bit, but by the time it turns and comes back, you're probably going to be more money than if you'd have bought it over here. So that's how I buy them, and I hope you understood all this. This is your strike price. It even says strike here. Here's your expiration. So you always know what you're buying at. And if you try to figure out by charting it, if you go back to, let's do a daily, and let's say you were buying calls here. All right, so let's see, this is moving, just trying to do a 10 day, there's 10 days right there. So if you look on that square, it says 13, or I'm sorry, it's 13 days. There's 10 days and 8 bars, okay? So at 10 days, it's moved 1.57%. So if you come down here, this is we call it 315. And then if we come up to here, that's $6, okay? So that's $6 difference. So if you're going to buy here and you think it's going to keep on going up, you could figure $6 of where you're going to go. So, if you're at 320, then you think it's going to go to 326. So you would come back over to your trading, and then you would do $6 here. So if you went 1, 2, 3, 4, 5, 6, that would put you there. Now you can still buy down here, and it will still make money. But if you're just trying to look to meet the strike price, then you can buy there and then go. And then when it gets $6, you go from 630 to 1, 2, 3, 4, 5, 6. There's 1035, so you'd be making roughly $400 per call on that, and that's over a period of about a week to 10 days, somewhere on through there, depending on how it moves. So, $400. That's going to be roughly what is that? About 65% or so that you would make on that call, and over a week's time. 65%, or even 30% a week is a lot of money. Most people that trade stocks usually are trying to make 3 to 5% a week. So if you can buy an option and make 30% in a week, then that's great. And let's just say it just skyrockets tomorrow and you're up 50%. Don't hold it for something else, because it may reverse on you. You lose that money. When you hit your goal, go ahead and sell it. And one thing you can do is, Once you buy it, you can go ahead and put a limit, and you can set it for 30%, 50%, whatever your goal is, and go ahead and put it for sale. And then when it hits that mark, it'll sell. Don't get greedy with your trades. You want to make sure that you're getting the percentage you want and doing the right way. So if you have any questions or anything, feel free to comment below, asking questions. I'll do my best to help you out, and hopefully this will help you as far as making it more comfortable to buy a call and a put, and be more familiar with the areas and your expirations where you want to do, because this is a lot to take in if you've never really looked at it or never traded it. But just keep watching the video over, and then you should be able to do real well on your next trade. Any questions, let me know. Appreciate you.